So what if your parents could help you buy a home without giving you any money? And no, they don't need to sell their car, tap into super, or even write you a check. They just need to have equity, which, let's be honest, a lot of Aussie parents do. So let's talk about guarantor loans, how they work, how they help, and most importantly, how to do them safely. In this video, I'm going to walk you through what a guarantor loan actually is, how it helps you buy with a small deposit and even no deposit, and what parents are really on the hook for, the key risks for both sides, and then how to remove the guarantee safely once you're in the home. So whether you're a first-time home buyer with very little saved or a parent thinking about how you can help, this is the full picture with the real numbers and real structure. But before we get started with this video, don't forget to hit the subscribe button. It really helps promote the channel so I can continue making educational content just for you. So let's start with what it's not. A guarantor home loan, also called a family pledge loan, lets a parent use the equity in their property to help secure a part of your loan. Usually it just covers the deposit gap. They're not giving you any money, they're not going on the loan with you, they're not making your repayments on your behalf, they're just pledging a portion of their property as extra security so that the bank sees your loan as a little less risky. And if it's structured right, you can get approved with a smaller deposit and avoid lender's mortgage insurance. This is one of the most powerful tools helping first-time home buyers and even first-time investors, especially when saving a 20% deposit is just out of reach. Say you're buying a home worth $600,000. You've just saved $20,000, which is just under that 5% deposit you may need for the first home guarantee. But to avoid LMI in this case, the bank wants to see a 20% deposit or 20% security. That's $120,000. So you're about $100,000 short. Now, instead of your parents gifting you that $100,000, your parents offer a limited guarantee for that amount, secured against the equity in their home. From the bank's point of view, it now looks like you have a full 20% deposit. You avoid lender's mortgage insurance, you get approved, and you even have a sharper interest rate. And best of all, your parents haven't handed over a single cent. Their home simply has a temporary legal charge on it for that $100,000. But, and this is key, you will still need to service the full loan with your own income. The guarantee helps with the security, not with your borrowing power. This is where a lot of parents get nervous. They ask, am I guaranteeing the full loan? And the answer is absolutely not. With a limited guarantee, they're only on the hook for the amount that is pledged. And in this case, that's $100,000. If your payments and everything goes to plan, their guarantee is actually never touched. But if something does go wrong and the bank sells your property at a loss, they'll come after your house first, and only if there's a shortfall are they coming after the guaranteed amount, which is when they would turn to your guarantor. So a limited guarantee is what helps protect your parents' home. This strategy works best for those who have a strong income, have good credit, but just don't quite have enough for a 20% deposit. That's a lot of first-time home buyers and first-time investors, especially in Sydney or Melbourne, where prices are moving faster than you could possibly save. So with a guarantor loan, you could avoid paying $15,000 to $30,000 in lender's mortgage insurance, get into the market sooner, start building equity earlier, and for parents, this is a way to help your kids without draining your super, pulling out cash, or gifting a six-figure sum. Of course, this is absolutely not a risk-free setup. Here's what guarantors need to consider. If the borrower defaults and the home is sold at a loss, the bank can enforce that guarantee. A mortgage is placed over the guarantor's property, even if it's fully paid off. The equity is then now tied up for the length of the guarantee, which now may affect future plans like investing, refinancing, or even buying that holiday home. Emotionally, if something goes wrong, this can create some strain on the family dynamic as well. So if you're the borrower, you need to respect the commitment. If you're the guarantor, don't sign anything without getting independent legal advice. This is a formal, enforceable responsibility you have. Now, a little direct word to the parents for a moment. If your home is fully paid off, you might be surprised to learn that you need to physically hand over the title to the bank while the guarantee is in place. Not permanently, of course, but while that guarantee is active, your home has a charge on it, just like when you had a mortgage. You're not making any repayments, but the title isn't yours to touch until the guarantee is released. And that is a big deal for some. You've worked hard to pay that home off, and handing it back, even on paper, can feel like a little bit of a backward step. So take your time, ask all the questions, and get that independent legal advice. And most importantly, you can use this chance to have a real open conversation with your child, because sometimes this kind of help can do more than just get them into a property. It can set them up for life with the right support and the right structure. So here is how to do it safely. Limit the guarantee. This is usually a standard practice. Lock in that capped amount. So back to our example, $100,000, not the full equity in the property. You can split the loan, one part secured by your home and the other by the guarantor. so you have a visual representation of that secured amount. Have an exit plan. Aim to release the guarantee in a 2 to 5 year period. Set repayment goals and pay down that guaranteed portion first. Communicate often and be very transparent about the repayments and the progress, because your parents have actually done a lot for you in this particular scenario. Some banks will give a 3-day cooling off period to your parents, but most won't actually proceed unless your parent has signed a legal advice certificate. This protects everyone involved and protects the relationship you have with your parents. So how do you get your parents off the hook for the parental guarantee? Once your loan drops to 80% of the property's value, you can apply to remove the guarantee. This happens for a multitude of reasons. You've either paid down the loan, the property has increased in value, or both. At that point, you'll either refinance or formally request for the guarantee to be released from your parents' property. And just like that, your parents again have full control over their property. I usually tell my clients, plan a 3 to 5 year window to release that guarantee, because you need to wait for the loan to be paid down and the property to increase in value. Guarantor loans are one of the most powerful ways to pass on an opportunity to your child, instead of actually handing over a bunch of cash. But it needs to be done right. If you're the borrower, stick to the plan. Treat your parents' equity like it's your own and aim to release them early. If you're the guarantor, absolutely do not feel pressured. Get the proper advice, because only a guarantee will come when you're truly comfortable with it. And now, when it's structured properly, this can be life-changing for both sides. If you're thinking about using a guarantor to buy your first home, your first investment, or even help your kids into their first properties, book a one-on-one session with me. The link is in the description.